Hey, it's Nancy from Baldwin Homes, Keller Williams, NJ Metro Group. My husband and I were recently talking. We have a house that we haven't quite figured out what we want to do with yet. Um, we've been trying to figure out whether or not we rent or sell it. So I want to talk a little bit about that today in terms of how we're coming to the decision that we're going to make. And a lot of it has to do with how you choose to hold your money accountable to you, and whether you choose to let money work for you. Okay. So basically, it's going to be a conversation in how to build your wealth. And we're going to start off with a baseline here of, the kind of rates of return that you get for certain types of investment. So there's kind of a rule of thumb, and the rule of thumb is if you have an investment that is at returning to you at between 1% to 4%. The reason why it's a frowny face is that's kind of considered dead money. Like having your money in a savings account that's earning, less than 1% really isn't earning anything for you. Money has the ability to do a lot more heavy lifting than that. Okay. So when you have investments that return to you at a rate of between 5 to 8%, that's pretty good. I would consider that sort of modest returns, not bad. Pretty darn good actually, in terms if you're not used to investing. And if you have rates of return that are between 9 and 12%, I would tell you that you're looking at some pretty solid returns, okay? And of course, if you have investments that are returning at a rate of 13 plus, yay! That means that you have some active investing going on and you are starting to build wealth, okay? So we have this house and we've been trying to figure out what to do with it. This house, we recognize after doing the market research, is probably worth about $700,000, okay? That's the value of the home. That's a conservative estimate, but let's work with conservative numbers. So that house is worth about $700,000. We currently have a mortgage on it of about $350,000, okay? So a mortgage of $350,000, which means that we have equity in the home of about $350,000, right? $350,000 because 350 plus 350 so equals 700. So the value of the mortgage plus the value of the equity added together make the value of the home right now 700. Okay. So here's that part we come back to. Do we rent it or do we sell it? So my husband and I were thinking maybe we'll rent it, right? Maybe we'll hold on to it. So the one thing is please be aware, we all kind of are on the same page about this, that the market is kind of at an all-time high right now. The real estate market has been functioning back in numbers that reflect numbers from 2006, which was the highest market I've ever seen in my working lifetime. So right now, it's, the market's pretty solidly healthy for selling. So bearing that in mind, we look to see how much we could get for rent for our house. And our house in our market area is probably worth about $5,000 a month in rent. Okay. And don't forget, let's look at what our monthly payment is. Our monthly mortgage payment, this includes taxes and insurance. Our monthly mortgage payment is probably around $3,800. So market rent, $5,000, current expenses right now, $3,800. So what does this mean? This means if I take $5,000 subtracted by $3,800, I get a monthly profit of about $1,200, which sounded really fantastic when we talked about it. I was like, $1,200, that's amazing. And if I take $1,200 and I multiply that by 12 months, I'm looking at $14,400 a year that I'm making on the house. Let's not worry about vacancy rates. Let's not worry about, things like that. We're just talking in broad numbers here. So let's go back and visit our basics. We have equity of $350,000 in the house, and I'm able to get a potential rent of $14,400. Okay. So how do we calculate the rate of return on a rental? I take $14,400 and I divide by 350,000, which gives me a rate of return of 4.1%. So if I rent out my home, I get a rate of return of 4.1%, which, as we figured out, is a sad smiley face because any situation where you are pulling back 4% or less, one would consider those maybe poor returns in relationship to what other investments could be doing for you. Now, I will tell you that my husband and I have I would tell you it's a relatively conservative approach towards investing. But we have a pretty diverse portfolio, pretty diversified portfolio. And the various elements in our portfolio right now are probably they have a rate of return between 12% to about 32%, giving us an average right now of about 21% on our other investments. So here's that part where I come to it, the question that remains, which is, if I rent out my house and get back 4%, right, versus say put the money in other investment vehicles that have a proven track record of over 13%, which is really about wealth building. Do I keep my money in this house, or do I take it out and invest it in other places? This is not a trick question. It's borderline on, I can't believe I'm even asking this question. I think I've already answered my own question. I think I know what to do. So if you are trying to decide what to do with your home right now, and given the fact that it is all-time low interest rates and all-time high prices, higher than I've ever seen, not since, like better than 2006 numbers for a lot of different places in the country, what are you doing? Why are you holding on to that house for rent? What's the rate of return? Let's think about this.